Today, we're diving into a head-to-head battle that's been raging for decades, stocks versus property. But not just any comparison, we're simulating 4 real-world strategies starting with just $50,000 cash and a $200,000 loan, totaling $250,000 invested back in January 2005. Fast forward to October 2025, that's 20 years of market chaos, booms, crashes, and everything in between. The goal? To show you the total returns after accounting for all costs, including those sneaky loan interests. Spoiler, not all paths lead to riches. Stick around to see which one turned $50,000 into life-changing wealth, and which one, well, didn't. If you're new here, hit that subscribe button and let's get investing. First, a quick disclaimer. This is historical data for education only. Past performance is not a guarantee of future results. Also assuming you live in the house, as no rental income is factored in. Let's roll. Start date, January 2005, and end date, October 10th, 2025, 20 years, 9 months. Initial outlay, $50,000 cash plus $200,000 loan equals $250,000 total investment. For scenarios 1 to 3, stocks, margin loan at 8.5% interest-only payments. For scenario 4, property, home loan at 7.5% interest on $200,000. Total interest over 20 years equals $300,000, plus ongoing property costs, more on that later. Now let's unpack each strategy one by one. Scenario 1. Aussie stocks $250,000 into the ASX 200 index. Picture this. You grab a margin loan and dump it all into Australia's top 200 companies, think BHP, Commonwealth Bank, Wesfarmers, CSL, just to name a few. You can do this with an ETF like STW, total return, price plus reinvested dividends. From 2005 to October 2025, it multiplied your money 5.3 times. Your $250,000 grows to $1,332,500. Repay the $200,000 loan and your equity is $1,132,500. Subtract your initial $50,000 cash. Gross profit, $1,082,500. Now hit it with that $340,000 interest drag. Net profit, $742,500. But could international markets do better? Let's see. Scenario 2. American returns. $250,000 into the S&P 500. Same setup, but you go global with America's top 500 blue-chip giants. Like Apple, Microsoft, Exxon, you can do this with an ETF like SPY, the S&P 500 crushed it. From 2005 to October 2025 and multiplied your investment 5.63 times. Your $250,000 investment balloons to $1,407,500. After repaying the $200,000 loan and minus the initial $50,000, and the gross is $1,157,500. Lastly, deduct the $340,000 interest, and net profit is $817,500, a step up from the ASX 200 returns. America's top 500 stocks delivered about 11% annualized returns. Impressive. Scenario 3. American technology, $250,000 into the Nasdaq Composite Index. Now we're talking high octane. You leverage into Nasdaq's tech beasts like Amazon, Tesla, Nvidia. Price alone went from approximately $2,175 to $23,000, 8.9x. But with dividends, total return to October 2025 multiplied your investment 12 times. Your stake explodes to $3 million. After loan payback, equity is $2,800,000, minus the $50,000 start. Gross is $2,750,000. After interest bite of $340,000, net profit is $2,410,000. Holy moly, Batman. Volatility wins. This one's approximately 14% annualized return with dividends. But remember, it tanked 30% plus in crashes like 2008 and 2022. High risk but high reward. Scenario 4. Australian housing, $250,000 into an average Brisbane house with a $50,000 deposit and a $200,000 home loan. Your property grows to $857,500. Repay the $200,000 loan and minus the $50,000 cash down, and the gross is $607,500. But wait, property ain't free. Interest, $300,000 plus. Council rates average to $2,000 per year over 20 years. Equals $40,000. House insurance over 20 years equals $33,000. House and yard maintenance at 1% of home value per year over 20 years equals $111,000. Total costs come to $484,000. Net profit comes in at $123,500 on your $250,000 investment. That's a multiple of about 0.5 times your investment after the hard grind. Time for the showdown. Here's the total returns breakdown after 20 years. Boom! Nasdaq still crushes it at $2.41 million net. The S&P 500 nets you $817,500, which edges out ASX 200 at $742,500. Brisbane property came in at $123,000. Poor growth and additional costs like rates, insurance, and repairs made this housing investment the worst of the options. Key takeaway: leverage amplifies wins and losses. American technology stocks plus dividends through Nasdaq 100 index investment wins, housing performed worst. What will you be investing in? Stocks or holding out for property? We all need a house to live in first, right? Drop your take in the comments and tell me which scenario you think you will pick going forward. If this sparked your investing fire, smash like, subscribe for more breakdowns, and hit the bell. Happy investing. And thanks for watching.